Hello, welcome back. Thank you so much for joining me today for cash versus accrual. So what is cash? What is accrual? These are accounting methods that we use to show the readers of our financial statements how we have recorded the income and expenses. Cash is very easy. We won't spend much time on cash. You record the expenses as they're paid and you record the income as it's received. That's it. That's all there is to it. So accrual is a lot more fun, and that's how we're going to keep Jack's books from here on out. So accrual just means that we are going to record the income as it's earned and the expenses as they're incurred, whether or not we have received any money or paid any money out. So let me show you how that works with an example. All right, so we have Mrs. Smith here. She is retired and on a fixed income. She has come to Jack and asked if he would do some refinish work for her and let her make payments to him. And of course, Jack said yes. So we get her set up with an account and she brings the furniture to him. So the first thing Jack needs to do is go to the local hardware store and pick up some supplies to get this work done. So he set up an account at that hardware store and he is going to go get some supplies now. There is a process that we go through. He fills out a form called a purchase order. Now look at a purchase order like a permission slip. This gets filled out by Jack. He takes it to the hardware store or gives it to somebody to take to the hardware store. They fulfill the order, give it to that person, and they give them an invoice as well. And this happens just so that nobody can just walk in and say, put that on Jack's account, okay? All right, so Jack gets this purchase order done. He went and picked up the supplies. He brings them back, and now we need to book this invoice from the hardware store. So we're going to start looking at our transactions like this. We've already talked about every single transaction has two sides. Our total debits must equal our total credits. So from here on out, we're going to look at it like this, and keep in mind that the left is always a debit, the right is always a credit. Now before we get this transaction booked, we need to add two new accounts to our chart of accounts. One is accounts receivable. This is an account set up for money to keep track of money that we have coming into us. This is what people owe us. So it goes in the assets section under current assets because we expect to receive those assets in a short period of time, those payments in a short period of time. Then we have the new account, accounts payable. This goes in current liabilities. It goes under the liability section under current liabilities because this is money we need to pay out in a short period of time. So there's our two new accounts. Now we can book our first transaction. We know our expenses are always a debit, so our supplies go here. The other side of the entry is accounts payable, a credit, and we know that liabilities are credits. So we have $30 under supplies and $30 under accounts payable. Now the next step to this is setting up a ledger card for the local hardware store. So we need to keep track of how much we owe each vendor that we have. So you'll find this in the vendor center, okay? So we record the date, their invoice number, and the amount of the invoice, which is $30. Okay, because imagine not having this information. We could have a huge amount of money in our accounts payable account. Without this, we wouldn't really know who we owe. We'd have to dig through invoices. It would be a nightmare. So that's the whole point behind setting up a vendor and keeping up with their invoices in that section. Okay, now let's talk about the next transaction. Will be Jack getting the work finished and we preparing an invoice for Mrs. Smith. So we give her an invoice for $500 and now we need to get it on the books. So here we go with this again. We are going to put the debit to accounts receivable because this is money coming into us. We have to look forward to receiving that at a later date. And the other side of the transaction is refinish sales. So now we have a debit in accounts receivable and a credit in sales. Now the same exact thing we did for the local hardware store we need to do for Mrs. Smith. We need to set her up with a card too, and this you will find in your customer section. So we open up, get a card all set up for her with her name, her address, phone number, all the necessary information, and then we record her invoice down here. It was invoice number 1 for $500. And this is how we can keep track of her payments and what she owes, discounts, finance charges, whatever. We can keep track of all of her information on here. That way, when our accounts receivable grows and grows, if we have 50 different customers, we know how much each one owes. Okay, nice and easy. Now let's talk about a payment. In your accounting software, you're probably going to go through a pay bills process. And what happens in that process, it just takes $30 out of the bank account. So here we are looking at it this way. It's going to take $30 out of the bank account and it's going to put a debit to accounts payable. Okay, because remember, when we want to decrease the number in accounts payable, we add to it. Exactly the opposite of what we do above the water, remember? So here's where the debit would go to accounts payable. So our accounts payable look like this, the balance in our general ledger. We make a payment, we add 30, and now it's back to 0. Okay? Now if we receive a payment from Mrs. Smith, and of course we record our $30 payment here. Now we have a balance due to the local hardware store of 0. Sorry about that. Okay, now Mrs. Smith comes in and she gives us a payment. So however your accounting software receives the payment, this is what it's going to do in the general ledger. It's going to post a credit to accounts receivable of $100 because we need to reduce now the amount that is owed to us with that payment. And of course, cash, it's going to increase the amount in our bank account by $100. So there's the two sides of our entry, all right? Then it would come over to her card, whatever the date is. This is a payment, minus $100. Her new balance is $400. And then of course, whatever the balances are on the cards will be over here in accounts receivable because it's also the balance in our general ledger. These are not posting. What's actually posting is when the transaction takes place, the invoice and the payment. These are set up for information purposes only, okay? But they still should, of course, tie to what is on your balance sheet and your general ledger. All right, so that takes care of cash and accrual. Thank you so much for joining me today. I'm looking forward to our next videos. We're going to cover some really fun transactions with prepaid expenses, accrued expenses, and a lot more. So I look forward to the next time.